We've often heard the term current account deficit, but it's not always that you hear current account surplus. According to the RBI data that has been released today, India has reported a current account surplus. What's the number? India's current account surplus for the quarter that ended in March stood at 13.5 billion for the January to March quarter of FY 24-25, and that's about 1.3% of the GDP. Has it always been like that? Is current account surplus always the case? Well, not really, because since 2013-2014, India has on an annual basis always been reporting current account deficit. This year as well, though on a yearly basis, the current account deficit is likely to, India is likely to record current account, there is likely to be a deficit. For the quarter, it has been a continuation of the positive signals that we've been getting over the past few quarters. What are the various reasons behind the increased surplus? What are the reasons behind current account surplus? Well, the reasons, according to the Reserve Bank of India, are strong performances in sectors such as services exports, especially in software, travel and business services. Increased remittances from Indians who are living abroad is another factor that contributes to the current account surplus. There is a slight narrowing of the merchandise trade deficit, but the overall trend is in continuation of the positive external balance trends that have been seen earlier. For the financial year, the current account deficit is likely to be fluctuating between 1 to 1.5% of the GDP, but that is well within the acceptable and permissible limits. And see, this is the first time in 4 quarters that we've witnessed a current account surplus. But it comes at a time when Indian economy is already showing signs of resilience. It's already showing, in fact, the Reserve Bank of India yesterday had said that the Indian economy remains extremely resilient despite the global pressures. For example, the frequency indicators such as e-way bills, GST revenue, toll collections, digital payments have all been displaying strength. Just to add to it, the RBI governor himself has about a month ago said that India's forex reserves are also very strong. That's the second very important indicator of a strong economy, and he had said that the forex reserves stand at USD 691.5 billion, which are sufficient to fund more than 11 months worth of Indian imports.
So on the whole, gross FDI is high, which indicates that India continues to be a good and attractive investment destination. External commercial borrowings and non-resident deposits, on the other hand, witnessed higher net inflows compared to the previous year, as on May 30, 2025, India's foreign exchange reserves stood at 691.5 billion US dollars. These are sufficient to fund more than 11 months of goods imports and about 96% of external debt outstanding. Overall, India's external sector remains resilient as key external sector vulnerability indicators continue to improve.
So that's another indicator. And the resilience of the Indian economy on the global stage is very, very visible because we are already putting a very strong fight or argument, so to say, when it comes to negotiating on Donald Trump's tariffs. So yes, these are all indicators of a strong and resilient economy.